Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Ian Colville. He's the founder and managing partner of Carpathian Capital Management, an alternative asset manager specializing in U.S. residential real estate development. And since launching the firm in 2012, Ian and his team have overseen more than $400 million in residential assets. He began his career in management consulting before he spent a decade in emerging market investment banking. He served as head of equity sales for both Deutsche Bank and Citigroup in Moscow, advising global institutional investors on Russian and CIS countries' opportunities. And after a stint as CEO of Dreamhouse Ukraine, then the largest wood frame construction firm, he returned to the U.S. and found his current company. So, Ian, thank you so much for being on the show today.
Thank you for having me, Charles. I'm excited to be here.
So you have a very extensive background in global investment. Can you tell us a little bit about yourself, both personally and professionally, before getting in 2012 to what you're doing now? I touched on a little bit, but if you want to go into a little bit more in depth.
Yeah, I'm from Rochester, Minnesota. I don't actually have any Russian roots, but back in the day, I ended up studying Russian in college because I thought that was a cool thing to do. I'd grown up with Ronald Reagan on the TV talking about Russia. And so then I worked in consulting and then went back to business school. As part of going to business school, I got a dual degree, a master's in international affairs. Where I picked up Russian again. My business degree was focused on finance and investing. In 2003, when I graduated, there was a Wharton alum in Moscow, Russia, who needed someone to come over and just do 3 months of financial modeling for a warehouse project that he was working on, a real estate investor. And somehow it turned into, I left with 2 suitcases and I came back 10 years later with a container full of stuff, a wife and a daughter. So that turned into investment banking with Deutsche Bank. And then I took a couple of years and did some real estate work in Ukraine and then came back and worked with Citibank. What that taught me and how that informs my our current investing is I saw a number of people in those markets who made money by investing just after a crisis or through a crisis or during a crisis, really sticking it out. And when unfortunately we had the great financial crisis back in the United States, I saw an interesting opportunity. And we can talk about that in a second, about how I transitioned into that.
Yeah. So tell us a little bit about kind of how when you got back here, what you were doing. So kind of what you were investing into, what your kind of business plan was before going into what you're doing now.
Yeah. So one of the things that, so there was the crisis theme that I got out of my time in Russia. And then if you recall, to get us out of the financial crisis, central banks around the world were printing a fair amount of money. And the thought was, the conventional wisdom was like, that's going to lead to inflation. It did, but it took a decade longer than people were expecting. But in times of inflation, you generally want to be in hard assets. So that could be real estate, commodities is pretty typical, real hard things that don't tend to have their value eroded by inflation. And at the time, houses in the United States were super cheap. And we also had very low interest rates. So we had a hard asset, which is a hedge against inflation. We have a very inexpensive asset. Homes were selling for well below replacement cost. And we had the ability to get really cheap leverage if you could qualify for it. So while I was working at Citibank, I would actually come back home, see some investors in New York, and then I'd buy like a $30,000 house in a suburb of Minneapolis. And so by the time I decided to make this a full-time thing, I personally owned 6 houses, and I had brought some investors in to invest in a 12-unit apartment building. So I kind of dipped my toes into the water. And then when it became time to leave Russia, it was just becoming less interesting. And I'm glad I did. I raised $5 million from people I'd met in the finance world. And that became our first fund. So raise $5 million, borrow $15 million from banks. We ended up buying $20 million worth of houses as our first fund. Should I keep going from there?
Yeah, definitely. No, okay. Yeah. Tell us about into what you're doing now. This is
very that was 2013, and we did it again. Raised another 5, borrowed another 15, bought another bunch of houses. So at our peak, we had about $40 million worth of houses. So by that point in 2015 or so, the surplus of homes had gone away. Home prices have been going up since about 2012. So I made a decision that we're getting into shortage territory here. It's clear that we need more houses in the United States. We need to invest in the creation of new units of housing. So I'm a financial person. The people who work here are financial people. Our expertise is not swinging hammers. So we started a private lending fund. So we make private loans to home builders, construction loans. We're more expensive than a bank, but we're also more flexible. We can do a little bit higher loan to cost. We can close quickly, et cetera. So we currently have about a $40 million loan book of loans outstanding to home builders here in Minnesota. And then a few years after that, we were starting to hear from home builders that even if they had unlimited cash, labor, and materials, they couldn't find enough buildable land to build their homes on. So the process of getting land from sort of a farmland or vacant state to have it ready to build a home on it can take a year or two. That's called land development. So we added on to our business a development finance business, and this is what we do the most of today. Is we find markets around the country that we really like. We find developers in those markets that we really like. Second generation, been around for 20 years. And then we look at the projects they have. And if all of three of those things come together and the developer wants outside capital, we'll typically form a joint venture where we put in something like 80% of the equity, partner puts in 20%. They go and do whatever project they've proposed to us. An example would be like a 190 home age targeted community in a suburb of Minneapolis is one of our projects, or 130 homes in Atlanta. And we split the profits from that development as things start to sell. We often negotiate a preferred equity structure, which helps mitigate some of the downside risk for our investors. So before I go into that, I'll just take me in what direction is the most interesting for.
Yeah, that's perfect. Yeah, one thing you touched on about a minute or so ago is the markets, choosing markets. And you're coming from an institutional background. We have a lot of investors that are on the show, whether it's their own funds or they're small syndicators that might have a different way of choosing markets. For one reason or another, they've located and they've identified that market as what they want to invest into. How have you, because you're going outside of where you live, obviously, you're going around the United States. Can you tell us just a couple of the key points that you want to see in a market that's making it more interesting to you and that really seals it for being something that you want to put funds in?
Yeah. Well, first of all, for the smaller investors, I just put a pitch out there and recognize that local knowledge is hugely valuable. So you may be in a market that's not the tightest housing market in the country, but if you know that this particular block or this project, or you've got this relationship which is getting you a good price, that's not necessarily, that's very valuable stuff. So you don't have to leave your home market to make money on a smaller scale. But when we are looking around the country, housing shortage is an obvious place to start. It used to be that we could say there's a shortage in just about every market in the United States. That's changed a bit during this period of higher interest rates. I would argue that in terms of housing units per capita, there's still a shortage in most markets, but in some markets, there's more supply of homes for sale than in others. So month supply of homes for sale is a very basic and key metric. Cincinnati, Ohio, one of the tightest home markets in the country, has like 1.8, 1.9 months supply of homes for sale. And some places in Florida, Miami-Dade, I think have 8 months. So you generally think of anything below 6 months supply of homes for sale is what's considered a shortage, and prices tend to go up. Above that, prices tend to be flat or go down. I can go more into how that metric is calculated.
Yeah,
that's
perfect.
Valuable, but, okay.
Please.
So month supplies, you take the number of homes for sale in whatever market you're in, and then you divide it by the average number of homes that sell per month. And you use a 12-month backward-looking average. So the average of the last 12 months, how many homes sold per month. So number of homes for sale divided by the number of homes that sell per month. That gives you a month's supply. So if I say this market has 4 months supply of homes, it means that in theory, if no new homes were ever listed for sale, which of course doesn't happen, but this is a good it's good for analytical purposes. If no new homes were listed for sale, in theory, that market would run out of homes to sell in 4 months. Everything that's currently listed would be sold, and there'd be nothing left. So that's a way of combining supply and demand into one metric. Supply is obviously the number of homes for sale. Demand is the number of homes that sell per month on average. So it's a good kind of quick rule of thumb sort of metric. And then from there, you look at things like affordability versus the average household income for the market, job growth. Is the market expanding or contracting? So economic factors, and then you get into I guess that's just on the market perspective. Once we're talking to a specific partner, and they say we do all the due diligence on the partner, and they say, all right, we like this deal in this location. Then we look real closely at the local market conditions around that location. So what comparable product is available for sale at what price? What is absorption in that particular area of town? How fast are homes selling at competing developments, et cetera.
And since, lending and interest rates are a large part of buying real estate in general, whether it's someone's residential single family home or whether it's a large commercial property, I imagine when you're saying affordability, under that umbrella encompasses also, monthly payments, what people are making in the sense of where mortgage rates are and where they might be in, I guess, 12, 18, 24 months when these properties are being sold?
Yeah, absolutely. And when you look at affordability calculations, you'll often see it measured as what percentage of average household income do you need to spend to make the average mortgage payment on the median priced house, something like that. So obviously mortgage payment has a heavy component of interest in there. So as interest rates go up with the average median income for the location, you're probably going to have to buy a cheaper house, a smaller house. And the inverse is also true. So we pay close attention to those types of issues. It's not just the price of the house, it's your monthly payment.
Right. Yeah, definitely, for sure. When investing in real estate, liquidity is always one thing when we're talking to passive investors, and they always want to know, how long they have to hold the investment for, how long, the whole process of everything like that. Especially, I think for seasoned real estate investors, they understand it's an illiquid investment, but maybe for some other ones coming from other asset classes, it might not be as much. How do you approach this topic with investors? And is there a way of providing LPs with more liquidity when they're working with your firm?
Yeah, I love this question. If individual investors, if they're just buying 1, 2, 3 houses, they're of course locked into that house until they sell it for the most part, unless they're getting some rental stream off of it. As you get into larger pools, raise a fund that's going to go buy 40 million of houses, or raise a fund that's going to go finance 8 different developments. You generally see 2 types of fund structures: open-ended and closed-ended. A closed-ended fund is one where you raise all the money up front. Then you go and execute whatever projects you're going to do, and investors in that fund just have to wait until the money comes back from those specific projects. After those projects return money from selling or rent or whatever, then the fund goes away. Investors can't move in and out of it during the operating or development years of the fund. We've done something a little bit different, which aims to provide more liquidity for investors in our latest development fund. An open-ended fund, and there we set a share price every quarter. Investors are welcome to put more money in at the share price, or they can redeem at that share price. The underlying assets in the fund are not shares of Microsoft, however. We can't just sell all of it all at once, or at least expect to get a good price for it. So there are some restrictions on the redemption process. We ask for a 1-year commitment to the fund. So there's a 1-year lockup. If you put money in, it's locked up for at least 1 year. We don't want fast money moving in and out, because you can't do developments with fast money. And the second thing is when somebody wants to redeem, they have to give us 6 months notice. So that gives us enough time to accumulate cash, either from selling a few homes or a few buildable lots at some of the projects, which happens in the normal course of the business anyway, or from a line of credit, or maybe we've got some investors that want to come into the fund. So it gives us enough time to accumulate some money and let investors redeem. If anyone's seriously thinking about it, there's a few more caveats in the in the documents about not everybody could get on at once, et cetera. But we're kind of trying to provide more liquidity than typical closed-ended funds, but certainly less than shares in Microsoft. So I'm careful to talk to investors about, for these returns, you give up something, and that's liquidity. But we're trying to make it as manageable as possible within the constraints of the asset class that we're in.
Right. I think when we had this conversation initially with investors, I think it comes up where if they are talking about it beforehand, I think it's also something you have to tell, hey, you've already sat in it for the most kind of riskiest, right? 2 years or 3 years of it. And now it's, you've gone through the hard part of it, right? If you're thinking that you want to, liquidate your position a couple of years into it, usually you've already gone through where we've had the unknowns and now we're kind of like on the stabilization portion of it. But obviously life events happen.
Those are the best times to own the assets. I think you're repositioning multifamily assets.
Right.
Do you provide investors liquidity midstream before the asset's sold?
We don't. It's something that if somebody really had an issue, we could do it. We could work it out depending on the size of their investment. We could probably talk to partners and figure it out. But it's something that we don't really allow it. And it's just something when I've spoken to other operators that have done it, it really becomes a mess. I mean, between it's a lot of work and a lot of legal, a lot of costs with it. And it's kind of just more important to even have these non-liquidity or illiquidity conversations beforehand. But obviously life happens. And I mean, I imagine sometime in the future, we will have an investor or so will want to, get out for whatever reason.
Yeah. So we've done plenty of closed-ended funds, and the asset class that you're in, probably unless you're huge and you sort of like do a publicly traded fund or something, what you do where you can't provide a lot of liquidity other than rental distributions or something makes sense. You can't go sell 5% of an apartment building to cash out one investor. The asset class that we're in is developments. So buy land, do land development, get it ready to build homes on it. Sometimes we're just selling off lots in onesie twosies to builders who then build the homes. Sometimes we're involved in the home building process. But either way, we actually are selling off 1% of the project, and we're selling a lot. We're selling a home. So we have a bit more cash coming back to us, which makes it a bit easier. But with buying and holding multifamily, there's all kinds of tax benefits to that. You get a lot of depreciation write-offs, and just letting your money sit and grow over time makes plenty of sense. But yes, it's less liquid.
Correct. Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. So you were talking before about when you're following the housing market, you're understanding where there's tight housing market. These are the places that you want to go. Another asset class that I saw in research for this was that you're focusing on age-restricted communities, which we haven't spoken too much about on the show. And it's very interesting where you're kind of seeing the next kind of place where there's going to be demand. Can you talk a little bit about why focusing on age-restricted communities is important?
Yeah, we didn't set out to have a focus on age-restricted communities, and I'd say that we don't really, but we've got a couple in the portfolio. Actually, the one in Atlanta just paid off, and investors made great returns, like 60% on their money. Some of it depends on what our partners are showing us. If we've picked a market and we've picked a partner, if that partner thinks their best projects are in age targeted, Our partner in Atlanta, Brock built a fantastic second generation, large private builder developer. They'll do regular communities, and they've got some age targeted communities, and it just depends on what makes sense for the submarket. But if you're doing it, there are some demographic tailwinds and other features of people who are aged 55 and older, active adult communities, where the homes are a little bit closer together. There's a central gathering area, etc. The first one is that demographically, we're talking. There's a portion of the population, like baby boomers, are a large portion of the population. There's just a lot of people in that segment of the population. Often people are selling a larger house and they're moving down to a smaller house. They tend to pay cash. So our development here in Minnesota, I think 70% of the homes were sold for all cash. So they're less interest rate sensitive. And sometimes that matters. In times of higher interest rates, it was nice to have some age targeted product out there where the buyers weren't thinking quite as much about where the interest rates were. So I think there's a demographic reason to invest in that segment. There can be a financial reason to invest in that segment. And then you just have to look at, where you're building the community. Are there competing communities of that type around? And in the submarkets that we chose, there weren't. We've got age targeted communities in the northern metro area here, but there wasn't much in the southern metro area. So similar situation in Atlanta with a great partner.
That's great. And I imagine in that 70% cash and that remaining 30%, those aren't people coming in probably with 20% down payments, 8% loan to value. They might be coming in 50-50 or whatever it might be. Higher down payments, larger down payments, making, again, the interest rate not as a large thing as it was before. So
I suspect that's the case. I went and did the work to find out what percent of people were paying in cash. I don't know the financing terms of what the other 30% were doing, but that would certainly make sense. Those folks are downsizing generally.
So after building a age-restricted community, something like this, what is the exit plan there? Is it for you to fill it and sell it to a operator that takes it off your hands, or the builder? I mean, so
the two communities that we've been involved with are for sale homes. They're not build to rent communities, although that's something we could invest in. We've looked at, but we don't have one in the portfolio right now. So it's literally develop the land, build the house sells to an end buyer, and we get a little bit of the cash back.
Perfect. Okay. So when we're talking about different markets, you're going back and forth about what you're looking for in those markets. And I think in certain markets, you'll find certain things like tax abatements that make a unique situation that really pushes development. We've also seen this with the 8,000 kind of quality QOZ zones, right, that were throughout the United States that can be earmarked for this huge tax abatement from 2017 kind of thing. But going forward with that, I mean, what are some other special situations that your firm has really taken advantage of that might have been overlooked or maybe not seen by typical investment companies that are out there?
Yeah, interesting. At our size, where we're looking to deploy, $5 million or $10 million at a time, we can get into projects of a size that most of the big funds overlook. They need to write a $50 million check. They can't be working in the areas that we are. So you said special situations and taxes. So I'll tell two special situation stories. One's about taxes and one is not. It's just an interesting special situation. So Brock built in Atlanta, an excellent partner. They had a plot of land under contract in Alpharetta, Georgia. It's one of the wealthiest submarkets of Atlanta, and it was right Main and Main, Alpharetta. Fantastic piece of land. They got it under contract. And the typical process is you then go and negotiate you put together your engineering diagrams, you go negotiate with the city. Takes a while to get your development approved on that land. And so you don't actually execute on the purchase agreement until you've got approval to do something on it. And that process took quite a while in the case of Alpharetta. So I believe they had this piece of land under contract for 3 years. And it happened to be during years where there was just an awful lot of appreciation happening. So by the time the city approved their project on it, They had the land under contract at $10 million, but it appraised at $17.8 million. And we generally won't put money into deals until the city has approved it. That's one of the risk mitigation strategies. In this case, the purchase agreement was about to expire. The seller didn't want to extend it yet again because they knew what value was in that land, and the $10 million price was just too low. So we made an exception in this case. Is we put our money into this project and worked with Brock to buy the land when they were about 95% of the way through the approval process. There was a few additional steps, administrative steps that need to happen. We and Brock did not want to lose this land. So instant equity, day one, we've made $7 million, at least according to the appraisal. And then we negotiated a put option where they would have to buy us out if they didn't get the project finally approved, which they did within a few months, and we're off and running. So that's a fantastic special situation where just because of the length of time, there's a valuation mismatch and there's instant equity there. The second one, which does involve taxes, is Cincinnati, Ohio. I said it's one of the tightest housing markets in the country, which is great. And then we have a great partner there, Onyx and East. But they also have, in certain neighborhoods, they have enormous property tax abatements available if you put certain environmentally friendly features into your home. So generally it will cost adds about $5,000 to $10,000 to the cost of building a home. But then the buyer of that home, it knocks about a third off what their monthly payment would be for 5 to 10 years. And it's an enormous benefit. And they have it mapped out such that it can literally be like, we're building on this side of the street and we can get this property tax abatement. But the folks on the other side of the street don't have access to it. So they've been very specific about where these things are happening. We have a 29 townhome development going on there, and it's we're very deliberate about taking into account, noticing that this is in on one of the blocks where you can get this property tax benefit. So buying our homes is significantly cheaper per month than buying homes at a development nearby, but they don't enjoy this feature.
Yeah, that's a fantastic benefit. And that's also one thing that you don't really have to, maybe not, I think at some point, your development, new construction is competing a little bit with existing product. But in this situation, I mean, you're completely outpacing it because of that savings over the first 10 years, which, I mean, $5,000, $10,000 more per home is really not much at all compared to the savings that somebody would have over that decade.
Yeah, it's pretty impressive. I have another special situation story that we don't benefit so much, but one of our end buyer does. We work with a fantastic partner in Florida to do land development for where D.R. Horton is the ultimate buyer at the end. So D.R. Horton they're the largest home builder in America. They find parcels of land where they want to build a community. They get it approved by the city, but they prefer to not have the land on their balance sheet while it's going through the land development process. For the most part, they only want it when it's ready to build homes on. That's what they can do their own land development, but they prefer for the most part to let someone else do it. So what they'll do is they'll turn the purchase agreement for this plot of land over to our partner there, and they'll say, you go do the land development. We'll sign a contract saying that we're going to buy it from you once it's ready. That's what we do. But the point of the story is D.R. Horton homes are often cheaper to buy in terms of your monthly payment because of the enormous insurance costs in Florida. So if you've got a home that's 20 years old and was built to a different building code, it can often be cheaper to buy a new D.R. Horton home because your insurance costs are so much lower. So I guess that's another example of a special situation that is a specific feature of the Florida market.
Yeah. It goes under that total umbrella of the affordability of your total payment. Really makes the difference to that end buyer, especially on that residential side. But very interesting. So with your firm, you worked abroad for many years. You now work with investors investing into your deals that are foreign investors. Can you talk a little bit about that? Maybe their perspective on the U.S. market and kind of what deals that they possibly enjoy more investing into and what's maybe important to them, stuff like this?
Yeah, it really depends on, waxes and wanes with foreigners' views of where the United States stands economically. There's been plenty of times when the U.S. dollar is strong and just holding investments in the United States. They were making money in their home currency terms just because the dollar was getting stronger. But then after that, it was fairly easy early on after the housing crisis to tell a story about hard asset, cheap homes, low leverage. So I got started with a lot of foreign money then, and those investors have tended to stick with us. They trust us. We've earned them money, etc. So I don't know that we've brought on. I guess every time we raise money, we bring on a few new foreign investors. But for the most part, the ones that we have been with us for a long time. And there's been some dollar weakness lately, so I hear a little bit of grumbling from the foreign investors. But the U.S. market is still viewed as a relatively robust place to invest. Politics is dampen that enthusiasm a bit, but for the moment, the economy is doing well.
Yeah. So as we're wrapping up here, Ian, I had a couple things here that we normally ask guests that come on. One of them being, what do you see as common mistakes that real estate investors make? I mean, over your past decades of doing this, from buying single family houses to now, building large communities and other land developments.
Excessive optimism, haircut everything. When we work with professional builders and developers in our development business, like I said, second generation firms, etc. But to be an investor, you're just by nature an optimistic sort. So we will often take our developers' forecasts and haircut them for our own internal expectations. We're perfectly happy if they meet what they think they're going to do, but we're okay if there's a 20% deviation from that. So be careful about optimism. And then liquidity matters in our borrowing or lending to home builders and rehabbers portfolio. We see people get in trouble if they have 4 rehabs or builds going on, and they're counting on one of those properties to sell to be able to finish some of the earlier stage properties. And then interest rates goes up and that whole cycle slows down, and then the whole thing blows up. So think about liquidity, not just the pace that the market's moving at currently. What if it gets worse? Do you really need to have 4 projects? Is maybe 3 okay? Seek to be in this business for the long term instead of will ultimately, I think, make you more money than trying to do it fast. Because at some point, if you're doing it too fast, the market may shift and you lose everything. You lose half of what you made.
Interesting perspective. What do you think are the main factors contributing to your success over these past few decades?
I think we've got a team of people here which has been doing investing for 20 plus years. And this business is 12 years old now, but the people that work here have more experience than I do. And they have strong relationships. So I guess in our development business, they're working with developers that they've worked with for a long time, even before joining us. So knowing who is really capable of executing, getting the job done. Sometimes we use that preferred equity structure, so we're delivering steady returns to our investors. If you can be steady, somewhat boring investors will keep coming back to you. So we got started by, I guess I got somewhat lucky, and I got a few people to give me money in the early days, and it was at a time when assets were cheap. But then we've spent a lot of time and effort on being as steady and boring as possible since then, so that it's an easy decision to reinvest a distribution or refer us to a friend, something like that.
So how can our listeners learn more about you and your business?
I will put the company website in the show notes, but it's carpathiancapital.com. get the spelling of Carpathian, you can just look up Carpathian Mountains, which is a mountain range in Eastern Europe. So carpathiancapital.com is where to find us.
Awesome. Well, Ian, thank you so much for coming on today. A great interview, and looking forward to connecting with you here in the near future.
Thank you, Charles. A lot of fun.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.